Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is October 1st, 2017 edition of Market Outlook. So let's first go into our tools section here on Market Gauge, look at Big View, and let's take a look at some of the key market indices because there's some real strength here in IWM. Just wanted to point out how we highlighted it over the last couple of weeks, and of course the overall condition of the markets. So first of all, you can see the Qs, right? The NASDAQ 100 punched out over the last 2 days above its 10-day moving average. You now have everything stacked and sloped, although still, as you can see at these highs here, that momentum at each high has been waning. Now we're not at a high here, so it'll have to see how this plays out if in fact we do get some continued strength. But for the short term right now, the Qs, even though it has the best performance for the year, up over 20% from a momentum standpoint, and our real motion indicators is showing relative weakness. Now, in terms of the S&P, we made an all-time new high, but momentum is still lagging as well. But overall, you cannot argue price is the final arbiter, more important than any other indicator. And again, closing on new highs, stacked and sloped, can't really argue with the action. So the momentum has sort of been passed. Let's take a look. You can see right here that the strongest momentum is occurring in the IWM, which is sort of picking up from where it had paused all the way back much earlier. We'll get into that in a moment. But as you can see right now, for the first time, we're over our 200-day of our real motion indicator. And not only that, broke out over this upwardly sloped channel line here, which is a really strong move. Now, if we take a look at the weekly charts, it sort of shows the bigger trends a little bit better. So first of all, on our real motion indicator, I had been pointing out that we had been sort of staying right beneath the 200 week of real motion in IWM, putting pressure on. We had this test of the 50-week moving average, successful test, and now for the first time since 2015, in terms of absolute momentum, IWM is really quite strong. And in fact, it's looking stronger than NASDAQ, which is not bad in itself, and certainly a lot stronger than the S&P, which still has not been able to surpass the momentum back in the mid part of 2015 on a weekly basis. Now the Dow, we have been pointing out, right, bigger caps, doing better, value stocks, a lot of those more populated in the Dow, and that's been doing well overall. So the two indices to focus on at the moment, IWM and the Dow as the two strongest. Another thing to highlight is what's happening with some of our risk-on, risk-off intermarket relationships. And one of the things you can see is utilities, right? This is our relationship between the SPY versus the XLU. And generally, XLU is viewed as a more conservative play. And while it started to, the SPY started to lose relative performance back in early August, we started to pick up here. And as you can see, we're getting really good relative strength in the S&P versus utilities. In fact, the highest it's been since March. So overall, really a positive sign. As you can see, here are the price charts of the two different indices, right? S&P beneath here on new highs, while utilities, right, going into a warning phase and definitely pretty weak. So this is a big component, or an important critical component of our risk-on, risk-off indicators, and this is showing that the S&P has really good absolute strength. Now, taking a look at some of the other key ratios that comprise of our risk on, risk off gauges, which are right over here, you can see, right, we had been, steadily improving last week, risk on 100%, and same thing over here on the close as of Friday. So as you can see, all of our risk on, risk off intermarket relationships are in positive mode. Can't argue with that, right? Wood versus gold. Again, pressure on gold. Lumber definitely in demand. Commodities definitely gaining strength. SPY versus gold. S&P versus gold. Also, you can see a move above both of their key moving average, the 6-month and the 1-month, which are represented by that light blue and the black. And same thing with high yield debt versus U.S. bonds, and bonds versus S&P, S&P outperforming as well. So across the board, all of our risk on indicators are showing good relative strength favoring stocks. In terms of volume analysis, you can see that we've got quite a number of accumulation days. That's a real positive. So if we go down to this table here, you can see over the last 2 weeks across all the indices, IWM, 5 accumulation days, 0 distribution. That's telling you there's some real strong strength. This is not a weak rally. Accumulation days means that volume is stronger on the up days than the prior day, and that is usually an indication of institutional buying. You've got sort of a middling view, neutral in the NASDAQ 100, not surprising. That hasn't made any progress over the last month as money has shifted to the IWM for the reasons I outlined. Tax reform most likely to benefit the Russell 2000 smaller cap companies domestically focused here in the US. And so again, focus on IWM as the strongest link here now, and most likely to pick up even more strength when you compare it to other indices. Again, the NASDAQ year to date up 22+%, where the Russell is only up 9.89% and gaining the majority of it over the last couple of weeks. Okay, so let's take a look at one other sector here of the economy that looks like it's going to be picking up, and that is based on this particular chart here. So if we go to our world view, right, inflation and gold, take a look at what's happening, and let's just focus on the longer term picture. If you focus on oil, USO, you can see a couple of things occur. Number one, let me get rid of this particular pen here and come up with a better one. That one seems to get a little bit of distortion here. Okay, so right here you can see we're just hovering around our 50-week moving average. So with that, we sort of have a bit of a head and shoulders pattern forming down here over the last 8 or 9 months. Now, what's also interesting, looking at our triple play indicator, which looks at the intermarket strength. So the USO, right, which is the US oil fund, is energy related, right? That's holdings of mostly crude oil and various energy commodities. Look at this. We're starting to now turn after bottoming out. We've been really, this is some of the lowest price of oil relative to the stock market. And for the moment, we're actually on our triple play indicators looking like we can really pop a nice rally here. And real motion indicator, right, which, here is our 50-week of real motion, the blue line, that is doing much better than the underlying price strength. So regarding price, momentum often precedes price. And you can see that as this thing has moved sideways, our real motion indicator is definitely showing good relative strength. And in fact, we're coming close to attacking the 200-week on real motion, where the price level is quite a bit higher. It's almost 80% higher here. So, back in 2015, we were trading, right around this 19 or 18 to 20 area. That's quite a bit higher. So you could possibly get a pretty decent move up here in crude oil. Certainly a move above this 12 level is really important. And of course, what I just pointed out is that we're sitting right at that 50-week moving average in price. That's important as well. So it looks like overall things are adding up, that our indicator here, our indications are that oil and the energy related sector could be regaining some strength, and certainly relative strength, as the overall market is still strong, and this particular sector, which has been really beat up, might really get some good relative strength to the upside. Okay, hope this helps. Bye for now, and see you next week.